Well, hey guys, welcome to my mini lecture on money, banks, and the Federal Reserve. This is going to be a pretty quick overview because I have a lot of follow-up written, technical kind of videos that get into it. But let's just get some background for what all these videos are going to try to be teaching us. So, money, you've probably seen it before. And if you're a student, you probably haven't seen as much of it as you wish. That's why you're a student for most of you. It's a really old thing. Human beings have been making money for more than 5,000 years. That's a long time. It's not like this new, amazing thing. We figured out a long time ago that it helps us to have money. And money helps us, especially economically. It helps us to avoid a barter system, which makes it much easier to find people who are willing to trade with each other. So we can specialize in trade, which means we can have more economic activity. We've already learned about specialization in trade, how it makes a bigger pie for everybody. Well, money kind of makes that possible. Not completely, but it really helps. So, a few things that we expect our money to do. We expect it to be a medium of exchange that people are willing to trade for it. We expect it to be a unit of account where we can measure things with it. We expect it to store value, meaning it's still useful later. And depending on your book, there might be a fourth one where it's a standard of deferred payment, which means you can pay for things with it later. A lot of books just lump that into either medium of exchange or I'm not going to get too picky on that personally. Now, what can serve as money? Well, anything. It has to satisfy those attributes, those things that we want money to do. We use paper, we use coins. There have been systems of money involving large stone wheels. There have been systems of money involving beads. Most of our money today is just electronic. But as long as it satisfies those things, it stores value, we're willing to trade it, and it helps measure things, then it's money, whether it has any intrinsic value or not. Now, as far as measuring your money supply, how much money is there, we'll talk about the M1 and the M2, different units of measurement. Basically, M1 covers the most liquid forms of money, the ones that can be spent most immediately. This is going to be your cash, your currency in circulation, your traveler's checks, stuff like that. I forgot checking accounts. Duh. I always lump that in with cash in my mind, even though they're totally not the same thing. Your M2 includes a lot of savings accounts and variations on that. They're not quite the same as checking accounts, but they're pretty dang close. It's easy to move money from savings to checking and then spend it. So I have a video on that. You can check it out if you want to. I also have a video on how banks create money. A lot of the money in those money supplies, M1 and M2, was never created by the Federal Reserve. It was created by the regular banks through a process of taking in deposits, holding some in reserves, and loaning out the rest. Banks make money primarily on loans, which means that they only keep some of the money on hand. So when you deposit money in the bank, they lend most of it out, and someone else receives that money, even though you still own that money. It's because they've created new money. I got a video on that too. You can check it out. I go through a lot of the details on what that looks like, including a money multiplier, which is the maximum amount of money that they can create based on a minimum reserve requirement. Now, we're also going to talk a lot about this Federal Reserve. I've already referenced it a few times as our central bank. What's a central bank do? Well, we created the Federal Reserve in this country more than 100 years ago to help stabilize the banking system, to help prevent banking panics. The Federal Reserve is a lender of last resort and can save struggling banks by giving them loans. But that's not all the Federal Reserve does. The Federal Reserve controls the money supply. Now, I just explained that money is created mostly by banks, so how does the Federal Reserve affect the money supply? Well, it does it through open market operations where it buys and sells financial assets from banks. It does it by changing the rate at which they're willing to lend to banks, the interest rate. The discount rate is what we call that one. And it does it by affecting the way we regulate banks, especially through their reserve ratio. When the Federal Reserve changes these kinds of policies, it changes how much money is in the economy. And so these monetary policies can have direct implications on our macroeconomy. And then the last thing this chapter talks about is the quantity theory of money, which basically says that if you print a whole bunch of money and your economy is not growing as fast as the money supply, you're going to create inflation, which just means prices will go up. So this is maybe my shortest mini lecture yet, but I have a lot of follow-up videos for it, so there's going to be a lot of material for you to figure out. But yeah, we like money. Money doesn't buy happiness. Nothing buys happiness, really. But money does facilitate a lot of good economic activity, and it helps things to go much more smoothly, and it has enabled us to have a system where we get a much higher standard of living than if we were all just trading chickens for grain or something. I like it. Anyway, I hope this is helpful to you so you can learn some econ, get smart, and go make some money. But if not, sorry. Good luck, guys. Happy econing.